Financial synergy, as there are different motive associated with a merger and acquisition. One of the motive is that the company wants to increase their financial synergy, and there are different sources of financial synergy. One is diversification, cash lag, tax benefit, or debt capacity. So first of all, we will discuss with diversification, as the diversification is the concept in which the companies indulge in different kind of businesses, or in some cases they want to reduce risk. The publicly limited company can merge with private limited company, as when we see that two publicly traded firm with diversified stakeholder cannot create much value, but if it could create wealth for private firms or closely held publicly traded firms. Secondly, cash lags. Cash lags is the concept in which the company has many opportunities, and they have very lucrative and profitable opportunities or projects available, but the main problem is that they have insufficient cash. So in that cases, the acquirer firm which having a sufficient amount of cash can acquire that business and create and avail that opportunity. Or thirdly, tax benefit, as tax paid by two companies separately is higher than the tax paid by them as individual firms. As when you increase when you merge with the other firm or acquire the other firm, your fixed asset would increase, and it has definitely a positive impact on your taxes, because depreciation is a tax deductible item. So when you have more of your fixed asset, your depreciation amount will increase, and it will decrease the tax amount. Or in some certain cases, when you have a firm with low profits, your taxes would be offset by their low incomes. So lastly, you have a debt capacity. When two company combine together, or so the other company which, or the both of the company who have a little or no capacity to carry debt, it will increase their capacity of debt, because when they combine with each other, and they can borrow money and create value for the firm. As in case of diversification, when we talk about a takeover, which is actually only motivated by diversification consideration, because has no effect on combined value of two firms involved in a takeover. The value of the firm will always be the sum of the values of the independent firms. But when in the case of a private firms or closely held firm, because in private firms or closely held firm, you have the owners are not so much diversified, so there might be a potential value gain from diversification. So it should be understand that in the public limited company, where the owners are very well diversified, because you have unlimited amount of shares which are being floated in the market, and you have different type of diversified kind of shareholders. So in that case, you might not have more value gain from diversification, because diversification because of a diversified kind of shareholders. But in the case of private firms, you can have value gain from diversification. Another concept of financial synergy or source of financial synergy is cash stack. And cash stack is the concept in which the companies have, or certain companies have good investment opportunities, but and they are very lucrative, but they cannot avail those opportunities because they don't have excess cash available. And if they want to avail those opportunities, they have to raise capital from either from debt market or equity market, and they don't want to do that, so they can reject those profitable opportunities. So in this kind of situation, an acquiring firm company which has cash available and very less investment or no investment opportunities, they can acquire those firms and avail those opportunities. The additional value which is being created by the combination of these firms lies in the present value of the projects that has to be that will is going to be taken, because they cannot, they are being availed due to availability of cash available by the merger. So they can, it can help to not only be the different kind of opportunity cannot be missed, but it can also enhance the value of the combined firm. It can be explained with the help of an example. For example, you can assume that Netscape has a severe capital rationing problem that result in approximately $500 million of investment, with a cumulative net present value of 100 million being rejected. So IBM has far more cash than promising project. So the IBM is another company, and they had cash available with them, and they had and has accumulated 4 million in cash that it is trying to invest. So and if they not, they are under pressure from their owners that they should go return this cash to the owners. So in this case, one company, Netscape, has the project, but due to capital rationing problem, that means that they cannot invest in other firm. The concept of cash rationing is that you can invest in the project up to a certain limit. You cannot increase that. So in that case, they cannot take that opportunity. But IBM, who has excess 4 billion, so they can invest in this project. So if IBM takes over Netscape Incorporation, it can argue that the value of the combined firm will increase by synergy benefit of $100 million, which is the present value of the project possessed by the later, that can now be taken with the excess cash from the former. That means that if IBM take over Netscape, it will help to increase the value of the merged firm by $100 million, which is actually the present value of the projects projects. So this would be a profitable opportunity for IBM, and the investment opportunities cannot be missed, and it will help to increase the value of both the firms. Another source of financial synergy is tax benefit due to the merger of the companies. For example, if one firm has tax deductions that it cannot use because it is losing money, they have tax deduction, and the other firm has income on which it pays significant taxes. That means that that one company is actually losing money. They are continuously in losses. Obviously, their tax would be deducted. But on the other hand, there is another company who is actually very profitable, and they have consistent income and good and obviously when they have a potential income, they have to pay significant taxes. When we combine both of these firms, it helps to give a benefit to the acquire or merge firm which has significant taxes, because they can share the tax deduction benefit of the company who is losing money. So when we want to find out the benefit from this, so the value of this synergy can be attained by calculating the present value of the tax saving that accrues due to the merger. Another thing is that when you merge with the other company, you can acquire the assets of the other company, which will actually take a which will give you new market value, and obviously when there is a high amount of tangible assets in the company, you have to calculate depreciation for that fixed asset. So in this case, increase in the depreciation will lead to decrease in the taxes. So this would also give the tax benefit to the company. It can be explained. Now, valuing tax benefit asset write-up. That means that when you take over the company, so how the depreciation will help you to decrease your taxes. So one of the earliest leverage buyout was done on Congolium Incorporation, a diversified firm in shipbuilding, flooring and automotive accessories in 1979 by the firm's own management. After the takeover, estimated to cost $400 million, the firm would be allowed to write up its asset to reflect their new market values and claim depreciation on the new values. The estimated change in depreciation, the present value effect of this depreciation discounted at the firm's cost of capital of 14.5% is shown below. So with the help of this table, we can discuss the benefits. For example, in 1980, the depreciation was before the $8, and after the merger the depreciation was $35.51. So change in depreciation is 27.51, and the tax benefit obviously is 13.20, and the present value of this benefit is 11.53%. Until up to 1986, they can avail this the present value or the tax saving from the from this merger was there. But after that, in 1987 and 88 and 89, your tax saving becomes zero. But in 1980 we can 1980 to 89, we can see that the total benefit you can get from this tax saving is $60, which has a present value of 41.76. So obviously, when you increase the amount, increase your asset due to merger or acquisition, you can avail the tax benefit due to increase in depreciation. Now, another source of financial synergy is that when you diversify, or when you merge with the other firm or acquire the other firm, it will increase your debt capacity, and obviously it has a positive impact on the value of the firm. As we can say that this diversification weight against the immediate transfer of wealth that occurs to existing bondholders in both firms from the stockholders. So when two firms in different businesses merge, the combined firm will have less variable earnings and may be able to borrow more and have than the individual firms. Obviously, due to diversification, obviously the benefit from different industries can be availed, and which will obviously have a positive impact of the earning and ultimately the value of the firm. With the help of following example, when two firms combine, the optimal debt ratio of 30% each, and end up with the firm with an optimal debt ratio of 40%. Effect on cost of capital of the added added debt. We have firm A and firm B. Both have a debt ratio of 30%. The cost of debt is 6% for firm A and 5.40% for firm B, and equity is ratio is 70 for both the firm. Cost of equity is 13.60 for firm A and 12.50 for firm B. WACC is 11.32% for firm A and 10.37% for B. And obviously, so for the same 5 years, and after the 5 year, the firm A has a WACC of 10.55%, and firm B has a WACC of 10.37 firm. So if there is no new debt, and the ratio become 30% when the both firm combine, their debt ratio with the debt ratio of 30%, as you haven't added any new debt, and the cost of debt, the debt would be 5.65%, and equity obviously is 70%. Cost of equity would be 12.95%. WACC would be decreased from up to 10.76%, and 7.6% and 7.95% consecutively for the 5 years. And after that, the year 5, your WACC would come up to 10.45%. But in the case of added debt, when now your debt ratio becomes 40%, 30 to 40%, your cost of debt would be same 5.65%, and your equity, obviously your ratio is not 60%, so your cost of equity would be increased, that is 13.65%. WACC would be now 10.45% for your 5 years, but after that your WACC would be declined to 9.7%. So this would be the significant effect on cost of capital, as the cost of capital would be decreased, and after the 5 year it will significantly decrease up to 9.7%, 76%. And how this added debt would have impact on the value of the firm. For example, the firm A has free cash flow in first year is 120 million dollars, and the firm B has 220, and in the second year firm A has 144 and firm B has 242, so on. In third year 172 for firm A and 266 for firm B, and two 207 in the fourth year for firm A, and 292.82 for firm B. And in the fifth year, the cash flow is 248.83 for firm A and 322.10 for firm B. And the terminal value for is 5,796.97 for firm A and 7,813.00 for firm B. Now, when AB is added with no new debt, the free cash flow for the first year is 340, for the second year 386, third year 4939, third year 439, fourth year 500.18, and in the fifth year it is 570.93. The terminal value is 13,609.97, and the present value is 9,781.30. And when the debt is added, the new free cash flow is for first year of the of combined firm is 340. In the second year is 386. In the fourth is 439. And in the fourth year is 500. In the fifth year is 570. The terminal value is 16,101.22, and the present value is 11,429.35. The value of the firm as a consequence of the added debt will increase from 9,781.382 million to 11,429.35 million. So it will help to increase the value of the firm, because with the added debt the cost of capital would be decreased, and when the cost of capital would be decreased, so obviously this would be less discounted, so therefore it has a positive impact on the value of firm when we add more debt to more debt into our debt capital ratio. Now, up till now, we have completed step third of the acquisition process. In the third, first of all, that what would be the motive of the acquisition. Secondly, you have to find out the suitable target. Third thing is that you have to value the acquisition. Now the first step is that how you can decide on the payment mechanism, that whether you go for cash or you can buy the stocks. So generally speaking, firm which believe that their stock is undervalued will not use stock to do acquisition. Conversely, firm which believe that their stock is over or correctly valued will use stock to acquisition. So when deciding about the mechanism, first of all you have to think, you have to properly ascertain that whether your stocks are properly valued or not. So the premium paid is large when acquisition is financed with stock rather than cash, and there might be an accounting rationale for using stock as opposed to cash. And secondly, you can allow to use pooling instead of purchase. So there might also be a tax rationale for using stock. Cash acquisition create tax liabilities to selling firms stakeholders. There are reasons behind choosing mechanism of your purchase or acquiring or merging with the firm. Depending upon that, what would be benefit for you, whether you want to go for cash, whether you go for stock. Firstly, if you think that your stock is undervalued, so obviously you will not use stock for acquire. Or if you think that the stock is overvalued, so obviously you will go for acquiring using stocks for acquiring the firm or firm. But when you use cash, so it's also important that the cash acquisition create the tax liability for the selling firm's stockholders. So all the things have to be considered, and after that you should decide about the mechanism of payment for your acquisition um, Now the exchange ratio in a stock for stock exchange. So how we'll determine that? So for correct exchange ratio to use in evaluation is equal to value per share of a target firm with a control premium and target control synergy divided by value per share of a bidding firm. And if the exchange ratio is too high, there will be a transfer of wealth from bidding firms stockholders to the target firm stockholder. And if the share exchange ratio is set too low, there will be the transfer of wealth from the target firm to the bidding firm's stockholders. So it's very important that you should determine and you should set a proper exchange ratio in order to get benefit from the acquiring or selling your firm. Setting the exchange ratio. In order to set the exchange ratio, we can take the example of digital and compact firm, which we have already discussed in the previous lectures, and we have taken the data from that. So the value of digital with synergy and control component is $6,964 million. This is obtained by adding the value of control of $2,422 million and the value of synergy of 2,421 million to the status quo value of 2,110 million. Digital also have 1,006 million in debt and 146.786 million shares outstanding. The maximum value per share for digital can then be estimated. For example, firm value debt divided by number of share outstanding. That is 6,964 minus 1,006 divided by 146.786. That is equal to 40.59. And the estimated value per share for compact is $27 based upon the value of the firm of 38,546.91 million, the debt outstanding of 3.2 million and 1,305.76 million shares. So the value per share for compact says 38,546.9 minus 13,200 divided by 1,305.76. So the value per share for compact is $27. So the appropriate exchange ratio based upon the value per share can be estimated by value per share of digital divided by value per share divided by complex. So for we can can calculate it that by the 40.59 is the value per share of digital and 27 is the value per share for compact. So dividing this, we will get 1.5 compact by digital shares. So the exchange ratio is that we can exchange 1.5 compact share with 1 digital shares. The fifth step or the last step of the acquisition process is that we have to choose an accounting method for merger and acquisition. There are basically two approaches. First approach is called as purchase method and second approach is called as the pooling of interest. So in the case of purchase method, the company which is acquiring the other company, they'll record their assets, liabilities of the acquired firm at market value, with goodwill capturing the difference between the market value of the market value and the value of the asset acquired. So this goodwill then be amortized through the amortization, and it is not generally tax deductible. And if a firm, although a portion of that can be attributed to asset, can be deducted, if a firm pays cash on an acquisition, it has to use purchase method to record the transaction. As you can record the value of your asset and liabilities, and at market value, and the difference would be amortized. The difference would be recorded as goodwill and goodwill, and so if a portion of is recorded in asset, so that can be amortized. And but the other method is called as pooling of interest. This method is used when the company is exchanging common stock with the common stock with other common stock of the acquired firm. The book value of the asset and liabilities of the merging firm are added to arrive at the value for the combined firm. That means that you will pool the asset and liabilities of the both the companies, acquiring company and the acquired company. And since the book value of the transaction is not recognized, so obviously you are just adding the values of both asset liabilities of both the firm. So there would be no goodwill because you are not recognizing the market values, and so obviously amortization is not applied over here. As we have discussed, that this approach is allowed when acquiring firm exchange its common stock for with the common stock of the acquired firm. And obviously, in this case, earning is not reflected, affected, and earning is not affected by the amortization or goodwill. The reporting earning per share under this approach will obviously greater than the reported earning per share in the purchase approach.